Hey there. So it looks like the bear market in US stocks is going to last longer than 3 more months. That's what the sector relative strength rankings are telling us. In the final 3 months of past bear markets, there was a pattern to those rankings. But today's trailing 3-month sector ranking looks nothing like that pattern. Now, this puts the drama surrounding the collapse of Silicon Valley Bank in a different light. If the bear market does continue, many will be inclined to blame the banking crisis. But the financial sector's relatively weak strength has been ongoing. It didn't just start in the past couple of trading sessions. Let's take a look at the utilities, consumer staples, and healthcare sectors, which were the top 3 performers over the final 3 months of all bear markets since 1970, according to data from Ned Davis Research. In fact, each of these outperformed the S&P 500 in all but one of those bear markets. But over the past 3 months, these 3 key sectors have been the worst performers. Yeah, they've significantly lagged the broad market. Check out the table accompanying this article for the comparable data for all 11 of the S&P 500's major sectors. While the full ranking doesn't completely follow a first shall be last script, it mostly does. The correlation coefficient between the historical ranking and the current one is minus 0.33, which means that the correlation is significantly inverse. It makes sense that certain sectors would perform better than others at the end of a bear market. That's when investors become despondent, as they finally throw in the towel on their erstwhile optimism. The most defensive sectors, utilities, consumer staples, and healthcare, should be hurt the least in this process. In contrast, the sectors most vulnerable during a bear market's last gasp will be those that are particularly sensitive to economic weakness, such as industrials, materials, and financials. Eagerness to jump on the bullish bandwagon is typical of a bear market rally. Investors in recent months were quick to believe that happy days were here again. They bid up economically sensitive sectors while downplaying defensive stocks. This eagerness to jump on the bullish bandwagon is typical of a bear market rally. At the beginning of a long-term bull market, there is instead a reluctance to believe, a stubborn insistence that the bear market is just taking a breather. If the next several months follow the typical Contra-Ryan script for a bear market, the October 2022 low will likely be revisited in coming months. As investors gradually realize their gullibility in believing that the October low was the final bear market low, they will swear off equities. You'll start seeing headlines to the effect that buy and hold is dead, or, even more dramatically, a repeat of the infamous Business Week headline in 1979, The Death of Equities. As Contra-Ryans like to remind us, that headline came near the beginning of one of the best decades for stocks in recent history. They would anticipate something similar this time around too, if and when investors collectively throw in the towel. But, as the past several months illustrate, be careful not to jump the gun.